Welcome over another episode of Financial 15. Lots of great information today. We talked a moment ago about fiscal policy. You can link to that video. Today we're looking at a companion piece, monetary policy. What is it? How do the central banks engage in monetary policy? Lots of great information. You want to stick around.
Yes, today is the Bank of Canada's yin to the federal government's yan in regard to fiscal and monetary policy. We want to talk about what's going on, how the tools are used, what the Bank of Canada can do, and show you exactly how this plays out with the economy going forward. But if you want to find this video, our fiscal one, or any other ones, please go to our YouTube channel and subscribe. It's easy. Click on the buttons. You'll have a lot of great content there. Also, like us on Facebook, and most importantly, visit our website at beckerorr.com. We have blogs, we have videos, we have events posted for everything there, things that you'll want to see, stuff to help out with your financial situation. But today, what we're talking about is monetary policy. We did fiscal. Monetary policy, basically, we're dealing with the Bank of Canada and things along those lines. But Clint, what exactly are we talking about when we mention monetary policy?
Let's just answer the question right off the hop. What is monetary policy? Well, central banks engage in monetary policy. So remember, fiscal policy was done by political actors, right? It was politicians. There's taxing, spending, monetary policy, not the case. We don't vote for anyone in the Bank of Canada. It's the central bank that engages in monetary policy, usually through interest rates, with the goal of stabilizing inflation. That is really their main goal for monetary policy, stabilize price levels, and it's done by the central bank. Now, there's lots of jargon in there. We'll go through the individual pieces. That's it in a nutshell. Monetary policy, central bank, dealing with interest rates, trying to stabilize inflation. In a nutshell, that is your monetary policy.
Yeah, and exactly. I mean, that's basically what their job is. As we've seen recently, what's gone on is we've had inflation go out of control. Prices have gone up. Everybody's complaining about what's there. How do we control that? Well, that's what the Bank of Canada is here to deal with. They're, as this states right here from the Bank of Canada source, they are to promote economic, financial welfare for Canada. But the monetary policy, if it mentions right there, keep inflation low and stable while they influence the supply of money circulating through the economy. So how do they do that? They do that with interest rates. And interest rate control is a lot of the problem. So again, they deal with the financial system, currencies, fund management, but their big goal, as we mentioned, is to keep inflation low and stable. Because when inflation gets out of control, that's when prices go up, wages go up, and things can create stagflation, which is another another scenario that we do not think is positive going forward by anywhere. They are basically the fiscal agent for the government of Canada. That's probably the easiest way as a definition to define what they are, at least in this country, right?
Exactly. So, I mean, different countries, different central banks. You mentioned in Canada, we have the Bank of Canada. They have multiple roles, Bank of Canada. This is taken right from the Bank of Canada website, so it's right off their website. They have a couple of functions. They do act as a fiscal agent for the government. They do control the currency, the actual physical printing of money, but their monetary policy obligations revolve around inflation. In the U.S., they have the Federal Reserve. That's the U.S. central bank. I won't go through all of this. They have other obligations, just like the Bank of Canada has other obligations, but specifically I'll highlight this. When it comes to monetary policy for the Federal Reserve, you'll note they have different objectives right here: promote maximum employment and stable prices. Stable prices would mean low inflation, but they have an employment objective as well as an inflation objective, whereas the Bank of Canada, with their monetary policy, solely an inflation objective. That is a key difference. Different countries, different central banks, different goals. Monetary policy will be engaged in a similar fashion, but always for different objectives. That can be the case. That is the case between Canada and the U.S. That was the reason we brought this up. Let's talk about how they actually engage in monetary policy. What are the different tools, Kevin? I'll throw you this one. We already mentioned it. Interest rates. That's the tip of the iceberg when it comes to central banks.
Well, yeah, I mean, basically, it's basic economics 101 if we take a look at it. If you increase interest rates high enough, the theory is that you'll take money out of the system. Right now, if interest rates were at zero, nobody's going to save money because they're not earning anything on it. They might as well spend it. If interest rates are at 10%, though, okay, I'm putting my money away because I can earn more money there than some of the things I need to buy. So that is how you take money out of the system and put money back into the system. So since we've got inflation high, what we want to do is we want to take money out of the system, because inflation, basically too much money chasing too few goods. So if all of a sudden we eliminate the money chasing the goods, all of a sudden things will start to get better. Inflation rate will come down. So their overnight rate, and that's what the government sets. They set an overnight rate, which then the banks use to set prime rates and everything along those lines. That's their controlling tool. So if they want to help with the economy and putting more money into it, they're going to lower rates. If they want to take money out of it, they're going to raise rates.
Yeah, and you're talking really about the carrot there, the incentive. It's also a bit of a stick, right? Because the cost of debt is very much linked to interest rates.
Yes.
So if someone wanted to buy a property, buy a car, and they didn't have the money, they'd get a loan or a mortgage. That's very common. And if rates are 2%, well, hey, maybe I'll get that loan. Not that big of a deal. If rates are 6, 7%, I might think twice about the spending in that purchase, right? So a bit of a carrot and a stick when it comes to interest rates and how it impacts the economy. Important note, overnight rate is exactly what it sounds like. It's when the big banks will leave money with the central bank overnight, and that'll be the rate they earn, and that'll influence how they set their rate. So it really controls the short end of the curve, the short-term interest rates, but that will influence expectations about longer-term rates as well. So by having a big impact on the short-term rates, they can influence what happens to the longer-term rates as well. But this isn't their only tool. They also have quantitative easing, or what can be called QE, often abbreviated when you hear it in the business media. But we didn't really talk about this at all before 2008. This is really a more recent central bank intervention, really an 08 going forward intervention. And what they're doing is they're physically stepping into the market and they're buying bonds. They're supporting the capital markets by actually buying the securities and expanding the central bank balance sheet. So that will help increase demand. They can do longer term items here. They can buy longer term bonds, which would more demand for the bond price goes up, the yield would come down, so they can influence longer term rates through quantitative easing, whereas the overnight rate that controls more on the shorter term. They can do both with these tools here, but this is more of a recent intervention, right? Really only since the Great Recession of 2008 that we've seen central banks engage in quantitative easing.
Yeah, and I mean, again, you're right. It's always been out there, but nobody ever really had the need to use it. And really, the Americans were the ones that came out with a lot of this first part, because in the 30s, what happened was you saw the Great Depression, and they wanted to avoid that going on again this time. So how do you do it? Well, as opposed to letting banks fail like they did in the 30s, we're not going to allow that to happen. So we're going to put money into the system. And how do we put money into the system? Just as Clint said, we're going to buy bonds. And we're going to make sure that there's money flowing in, so that there's capital going into the banking institutions, so that you can feel comfortable that the economy is still going to run going forward. So again, they really discovered what they could do with this, and they avoided a big recession and everything else that could have been a lot worse than what it was by actually dealing with this sort of a scenario. So that's the first part of the thing. But as you've mentioned, there's also a twist side to that as well. You can do sort of a quantitative tightening scenario, which is what we're doing now. We don't want to put any more money into the system. So guess what? Governments are stopping the bond buying. They're not doing it anymore because we want to take money out of the system. So you've got two sides that you can do. Same thing with interest rates up and down. You can do the quantitative easing or quantitative tightening. Either one of those things, depending on your economic situation.
Yeah, and that comes right into how they usually combine these tools. There's an expansionary monetary policy, and then there's going to be the contractionary monetary policy. The expansionary monetary policy, really, if the economy is in a tough time, it's in a downturn, it's in a recession, you'd see central banks lower those overnight rates, lower the interest rates, provide that incentive for people to go out and spend, because they're not going to get as much in the bank and debt's going to be cheaper. And then, like we just talked about, quantitative easing, they'll step into the market, they'll be buying those bonds, providing that support for the capital markets, trying to encourage economic activity, to get the ball rolling, so to speak, for the economy. And then there's the flip side of that, Kevin. When the economy maybe is a little too heated, inflation would be rearing its ugly head. Remember, the Bank of Canada very laser focused on inflation when it comes to monetary policy. And it's essentially what we're seeing now is the contractionary side of monetary policy.
Yeah, exactly. And you're getting the exact opposite scenario, right? Inflation's there. We've seen rates that have gone up the fastest they've done in 40 years. Why? Because all of a sudden we have to stop that high inflation. The only way you're doing that, as we mentioned, first off on the Bank of Canada side, or central bank side as it is, you're getting those interest rate increases, and they've been substantial over the last little while. Also, their quantitative tightening has kicked in. You're starting to see that's been done in the US. The European Central Bank is also going to be starting to do that fairly soon. Again, anything to slow down inflation and slow down that economic activity, because it's become overheated after we've dealt with the pandemic.
Exactly. And we'll go through some real world examples here. We'll look at some of the data from the Bank of Canada to show you how these tools can be used in both expansionary and contractionary phases. I'll pull up the first one here, and this is looking at what you just talked about there, Kevin, the quantitative easing. And I'll make this full screen so everyone can see. And you might notice there's a little bit of a jump in the pandemic there of 2020. But this is the bank balance sheet, essentially the total assets. And when they engage in quantitative easing, they're stepping into the market, they're buying bonds, they're supporting capital markets, they're expanding their balance sheet. You saw a bump here in 2008, 2009. It went back down. Then you had a steady stream of quantitative easing to support the markets, and then a huge increase with the pandemic. They really threw the kitchen sink at the pandemic.
Yeah, exactly.
And now we're seeing what you just talked about, that quantitative tightening. They're shrinking the balance sheet. They're selling the bonds. They're letting them expire and mature. They're no longer adding that level of support. And you're seeing that come out of the capital markets, that contractionary phase. And then let's talk about this one. That's the really how they do the QE. This would be a good example of the overnight rate. Now, this goes back to the 80s. So you see quite the spectrum here, Kevin, but what's going on?
Well, yeah. And again, at the late 70s, coming out of recession and everything else, all of a sudden, when you get economic stimulus, the inflation ran and nobody did anything about it into the early 80s. Then they discovered they had to. So you've seen those 20, 21% interest rates. And basically what you saw straight through till recently was roughly a slide all the way down. Rates went down. They went up a little bit when you started to stimulate the economy, or when you had to start to take away the inflation that came up. But we basically seen a steady decline from 21% to roughly 2% for the longest period of time. Yeah. Again, from basically 2009 onward, we haven't really had interest rates. So this is the first we've seen. This shows to the end of September, which is about 2.75. We're at roughly 3.75 now. But again, that's something that we have to look at and see where it's going. So yeah, monetary policy, as you can see, it's to maintain those low interest rates, low inflation, and everything else moving forward. And it's been done by the Bank of Canada all this time.
Yeah, so there's two real-world examples of how they use those tools and the impact it can have on the economy. If you have more questions on this or anything else, let us know. We'd love to hear from you. Chat with ClintonandKevin.com, bottom of the screen there. Go to that page, fill in the details. We'd absolutely love to hear from you, whatever the question might be. Any parting words for the folks, Kevin?
Actually, I think that we've covered it fairly well. We've done fiscal, we've done monetary. We'll do more of this as we go forward. Other than that, make sure that you enjoy and watch more videos going forward.
Take care.